Let's go to the personal income tax. What we are trying to see here is an attempt to create an additional tax slab. There is no change in the basic exemption, and in the first slab of 10%, the 0.3 is the education cess of 3%. These are all tax slabs with which we are probably familiar with. But when you come to a level of more than 1 crore of income, please note, not wealth, income, we are seeing a tax slab of about 35% being created. It was not created this year, it was created earlier. This year they have increased the surcharge from 12% to 15%. So how we arrive at this complicated figure is 30% of tax plus 15% of surcharge. That is 15% of 30 is 4.5. It comes to 34.5. And on that 34.5, a 3% cess takes you to 35.54. I have no problem if they wanted to create a new tax slab, because that is the worldwide trend now, to create a new tax slab of about 35%. Even in the United States, the current federal tax rate is about 35% or 36%. Now the problem is the way they are seeking to achieve it. The way they are seeking to achieve it is not by creating a tax slab. What they are doing is, they have this whole system of surcharge and cess. Surcharge and cess is a very confusing and a very poor way of taxing people. Surcharge and cess is allowed by the Constitution of India, but the Constitution had made it very clear that this kind of thing can be done only in the case of emergencies like famine, natural disasters, perhaps war. You can impose it, and it should be imposed for a brief period. The moment you have collected money for that particular objective, it should be done away with. But in our taxes, if you see, education cess has been there for years and years. When it was first introduced, it was supposed to be only for 1 year. Then every year it got a fresh lease of life. Now it is almost a part of the income tax law. Same thing with surcharge. So the British Raj might have gone, but not the surcharge and cess Raj. That is continuing. And this is bad for taxation. I would have had no problem if you just say 10, 20, 30, 35. Fine, have it as a tax slab. More than 1 crore. It is fine. And this whole thing is, in economics there are fashions. Fashions come and go. The current fashion, at least from the last 2 years, has been something called taking care of or addressing this whole issue of inequality. I will tell you the background to it a little later. In a view to address, or with a view to address the issue of inequality, it entails taking money from the very rich and distributing it at the bottom of the pyramid. So from that point of view, this kind of a new tax slab, when you see this income figure of 1 crore plus, is all right. It's not going to affect the common man. It's not going to affect probably even the middle class or slightly upper middle class people. It's going to really affect the rich people. Tax rebate from 2,000 to 5,000. If you are earning income of less than 5 lakh rupees, on whatever tax you have to pay, you are given a further 5,000 off. But people who are earning between 2.5 lakhs and 5 lakhs, what is their tax slab? Tax slab is about 10%. When you give them a rebate of 5,000, isn't it the same as giving them a higher basic exemption of about 50,000 rupees? What the government has done is, it does not want to get rid of any of the taxpayers. If I am earning 2.8 lakhs, let us say, because my 2.8 lakhs of earning is more than 2.5 lakhs, I have to file a return of income. My paperwork is there in the income tax department collecting. Had the basic exemption been made 3 lakhs, I could stop filing income tax returns. objective is supposed to be to broaden the tax base. But my simple question is, what is the point of broadening the tax base? You can broaden it all you want if you are not collecting money from it. Number two, you are making a lot of people who don't have to pay tax file returns. You are giving them more work. You are giving the income tax department more work. It makes no sense. It is okay if your so-called 2 crore taxpayers disappear. Focus on the bigger fish. That would have been, you would have released resources. Plus, there is something that I repeatedly see our finance ministers, even people of the caliber of, let's say, P. Chidambaram or Arun Jaitley, there is one thing that they miss, and that is, just as armed forces need what is called morale, we also need a certain morale in the economic scheme of things. The people of the country should feel good. You can feel good sometimes by a simple visionary thing like increase the basic exemption by 50,000. That would have made headlines. A little bit of savings, 1.5 lakhs. Selectively, only the NPS you give another 50,000. Some housing loan interest somewhere, selectively you give another 50,000. Section 80C was 1,50,000. It's been 1,50,000 for several years. We have had such high inflation in the last years. Make that 1,50,000 to 2 lakhs. You are not going to lose much revenue. In the basic exemption hike of 2,50,000 to 3 lakhs, you are not going to lose any revenue because you are giving a rebate in any case. 1,50,000 to 2 lakhs in Section 80C, you will lose a little revenue, but negligible. Negligible. On the other hand, the benefit to the economic morale of the country would be immeasurable. And the economic result of increasing that morale would be superb because it would give people an incentive to increase their productive activities. Unfortunately, that kind of leadership was not shown. House rent allowance is a very good move. This is an excellent move. For so long it has been trapped at that 24,000 rupees per year. So people today who do not have a house, so they have to take rental accommodation, or the employers do not give them a house rent allowance. From 24,000, the limit has now been increased to 60,000 rupees. So some relief is definitely going to be given to such people. And those of you who are filing your returns, or those of you who are doing it through a chartered accountant, ensure that you get this benefit if you do not have your own house and if you are eligible for it. For those buying their first home, some sort of an incentive has been given. You have an additional deduction of 50,000 rupees interest per financial year, but it is selective. The loan cannot be more than 35 lakhs and the value of your house cannot be more than 50 lakh rupees. Now take a city like Mangalore. If you see it in a rank of cities in India, it's probably somewhere in the 60 to 65 number. 63rd, 64th, based on various size and population and so on and so forth. Now, we had an uncontrolled real estate boom between 2003 and 2013. But over the last 2 years, real estate is in a very bad shape. Despite this, in a good locality, it would be difficult to get a brand new 2-bedroom apartment for 50 lakh rupees. Second hand you may get, or somewhere pushed back you may get. Even in a good locality, this move may help revive a second-hand market in apartments that are, let's say, 8 years, 10 years old, if you can fit it with this. Some incentive has been given, but I wish the limits there were a little larger, not 50 lakhs, a little more. And the loan also, loan of about 50 or 60 lakh and a cost of about 75 lakh, I think would have been more in tune with reality. Small business people and small professionals, the presumptive taxation limits have been increased. What is presumptive taxation? Presumptive taxation is, if you are a small businessman or businesswoman whose turnover is not more than 2 crores per year, or if you are a small professional, an advocate, an engineer, some sort of consultant, whose total income receipts are not more than 50 lakh rupees per year, then you need not maintain detailed books of account. Only some basic material to show how much is your turnover. And 8% of your business turnover, that means if your turnover is 2 crores, 16 lakhs will be considered your income and you have to pay tax on it. It is assumed. Or if you are a professional, 50 lakhs, 25 lakhs is considered your income, you have to pay tax on that. Now, this is not compulsory. You have a choice. You can be well within this limit and say, nothing doing, I don't want this presumptive taxation. I am going to maintain my full accounts. I am going to audit them. I am going to file returns accordingly. Or you can opt for this if you want to maintain lesser income. But a chartered accountant friend of mine pointed out that proportional or related amendments may also have to be made in that 44AB statutory audit where the limit is still 100 lakhs. Oh, sorry, yeah, 1 crore, not 2 crores. So all those problems have to be sorted out. Essentially, once again, some relief is being given to the smaller people here, which on the whole is not bad. Now we come to a very bad aspect of the budget, and that is the proposed tax on dividends for the people who are earning more than 10 lakhs. When you hear of it, if you are a person who is more socialist, it's a very welcome move. If you take a diversified portfolio today and check out the dividend yield on the NSE 50 or the Nifty index. In short, if you have a diversified portfolio of equity shares and that diversified portfolio is giving you 10 lakhs of dividend per year, the size of your portfolio should be roughly around 6.5 crores or so, because the dividend yields are about 1.5, 1.54%. So if if you're going to impose an additional dividend tax on someone who is getting more than 10 lakh rupees of dividends, that means the portfolio size that the person is holding is about 6.5 to 7 crores. So you're taxing the very rich. Like we saw that 35% tax bracket there is on people with income of more than 1 crore. This is what it looks like on the surface, but it needs a little examination. Tax at the rate of 10% of gross amount of dividend will be payable by individuals, HUFs and partnerships receiving dividends in excess of 10 lakhs per financial year. My first objection to this is right here on the screen. This tax has not been imposed on everyone. Only 3 people, 3 categories: individuals, Hindu undivided families and partnership firms. Not on others. It is selective. This is in addition to dividend distribution tax. And dividend distribution tax itself, the government fools people. If you read, they'll say 15%. It is not 15%. It amounts to 20.36%. Why and how, allow me 2-3 minutes, I will explain to you. But right now, take it from me that it is 20.36%. This additional tax will be on the entire amount of dividend once dividend crosses 10 lakhs. Some chartered accountants are trying to take a view that 10 lakhs is a sort of exemption. So if you are earning 12 lakhs, the 10% will be only on 2 lakhs. But a reading of the act, I don't know. My reading of it is that it is from rupee 1 once you cross 10 lakhs. And paper like the Business Line, which generally does its research correctly, also appears to have said the same thing. For instance, where an individual has earned a total dividend income of rupees 11 lakhs in financial year 2016-17, she will have to pay a tax of 1.1 lakh rupees and not 10,000. Please note. This is injustice. This is not correct. Unfortunately, no marginal relief has been allowed to taxpayers receiving dividend marginally higher than 10 lakhs. In the Income Tax Act, when somebody is just over 1 crore and the 15% surcharge kicks in there, they will be actually left with a lesser income than somebody earning 99 lakhs. For that, there is a concept called marginal relief where the surcharge is reduced until that ill effect of just crossing the border is neutralized. That is fair. Such a thing has not been provided for the proposed additional dividend tax. For instance, where the taxpayer earns dividend of rupees 9.99 lakhs, the additional tax will not be levied. However, if the taxpayer earns just 2,000 rupees more, 10.01, your loss is 1 lakh. So by earning 10.01 lakhs of dividend, you end up poorer than the guy who's earning 9.99 lakhs. Once again, there is no logic. This is injustice. There is no doubt about it. I hope somebody challenges it once the Finance Act is passed. Let us also take another angle. Let us put the whole idea of dividend in a certain context. Who earns dividend? Dividend is not interest on a bank deposit or a debenture or a bond. When I earn dividend, I am a shareholder. When I am a shareholder, I am a part owner of a company. I am a business person. I may not have the rights of management, but I am a business person. That's why I am a shareholder. The company, let's assume, makes profits. The company now arrives, prepares its final accounts and arrives at a figure called NPAT, net profit after tax. After tax. Then the company on that net profit pays tax at the rate of 34.61%. Only after this dividend is declared. Any tax on dividend, therefore, is a straight case of double taxation. Nobody bothers about it because, unfortunately, shareholders in this country are not seen or assumed to be a voting bloc. Contrast this with what happened in Employees' Provident Fund. The government was not bothered about what it had to do or how it bungled there. Do you think that the whole proposal was withdrawn, the EPF proposal, because of the government's love for its EPF holders? No. There are 3.75 crores of them. If somebody is earning EPF, that person is likely to be a voter. What will happen at the next election? That is why it was withdrawn. Nobody is trying to calculate how many people there are who are receiving dividends in this country. Forget about the people above 10 lakhs. The injustice is done even to the normal non-10 lakh people, because the dividend is paid after tax of 34.61%, which is high by world standards on corporate taxation. Moving further, this is the first point of taxation on your corporate profit, and you're an owner, please remember. Now for the privilege of receiving my share of dividend, which has been paid out of profits that have been taxed, the dividend distribution tax is levied. DDT is 20.36. This is the second point at which corporate profit is taxed. Already there is double taxation. Finally, on dividends in excess of rupees 10 lakhs received per financial year, I have to pay tax of 10%. Welcome to triple taxation. So we have to ask the question, is this taxation or is this tax terrorism? Is this theft? And this is on a section of people whose voice is hardly heard. It is hardly heard. Once again, in lighter vein, the whole objective appears to be to catch hold of people from whom money can be extracted, squeeze them to the maximum possible extent. If you want to know what is the fate of a taxpayer in this country, look at the person who is preparing sugarcane juice. It is sent through the machine, folded, sent again, folded for the next time, till it can be folded no more. So every drop of juice has been extracted. That's the kind of attitude that we unfortunately have in this country. Everywhere you will find 15% DDT, dividend distribution tax. No, there was 15% dividend distribution tax before 30th September 2014. But after that inauspicious date, things changed. What happened? By a simple sleight of hand, by changing a few words, they changed the whole concept of the dividend distribution tax. They used the words grossing up. What does it mean? Until 30th September 2014, dividend distribution tax was calculated on dividend distributed at 15% plus surcharge plus cess. After that, the dividend paid is presumed to be 85% and must be grossed up to 100%. I'll explain this by an example. Dividend distribution tax must be calculated on this grossed up figure. Surcharge and cess will thereafter play additional havoc. Let us come to an example to understand this atrocity. Dividend distributed is 100. Grossed up dividend is that 100 has to be multiplied by 100 bar 85 to get this fictional figure of 117.65. Now your dividend distribution tax of 15% has to be calculated on that figure. You get 17.65. Add a surcharge of 12%. That's another 2 rupees. Add cess, another 59 or 60 paise. Do the total, you get 20.36 rupees on every 100 rupees. Therefore, the dividend distribution tax paid by shareholders of this country is 20.36%, not 15%. But if you ask the government tells you it is 15%. An attempt to take away more money from the rich, an attempt to give certain benefits to the poor, lower middle class is a kind of a running theme in this budget. I'm trying to explain to you the background behind such a move because it is important that we understand it. In the budget speech, the finance minister actually gave a clear indication about what he was going to do. When he came to direct taxes, what he said was, taxation is a major tool available to government for removing poverty and inequality from society. I want to talk a little bit on the one word called inequality and put it in an economic context. What has he done? Surcharge on people earning more than 1 crore, it was already there, 12%. He increased it to 15%. That was taking a little bit more money away from the rich. Tax rebate for those earning less than 5 lakh rupees. Increase it from 2,000 to 5,000. You give something to the poor. House rent allowance exemption limit hiked. Once again, give something to the poor. Additional interest deduction on first home purchase. That too for loans only up to 35 lakh rupees. For a house valued at only 50 lakh rupees. Middle class, lower middle class, okay, you're giving something. Increase in presumptive taxation limits of turnover and receipts of small businesses and small professionals. Once again, small, you're giving some relief there to the small person. Triple taxation on dividend receipts of more than rupees 10 lakhs. Fair, unfair, just, unjust, for a moment we leave it aside. But I told you that if somebody has to receive 10 lakh rupees of dividends per financial year, their equity portfolio would generally be 6.5, 7 crores. So once again, you're hitting the rich there. So you're seeing this, hit the rich, give money to the poor. Why? In 2013, a French economist called Thomas Piketty published a very influential book called Capital in the 21st Century. It is not that the debate about inequality was absent before this particular book was published. But this book reignited the whole debate. And in economics, as elsewhere, there are ideas that get thrown up. Some ideas become fashionable. Then after some time they die out. But the whole thing is equality and inequality came to the center stage of global economic discourse, not just in India. Inequality is bad, period. We have to move towards equality. There is no doubt about it. The question is, how? And a lot of people ask this question, can the poor be made rich by making the rich poor? It is a question that is open to debate. There are no simple answers, yes or no. But what we are now learning, and believe me, we are still learning, is that the manner in which inequality is tackled is important. If we take extremist measures, it fails. If we take incremental measures, it succeeds. This budget took certain incrementalist measures. We will examine that a little later. Before that, can we measure inequality, and how do we measure it? In 1912, Italian sociologist called Corrado Gini came out with a measure called the Gini coefficient. You'll be hearing about it more and more as this debate about inequality rages. The Gini coefficient, also called the Gini index or Gini ratio, is a measure of statistical dispersion intended to represent the income distribution of a nation's residents and is the most commonly used measure of inequality. 1912 to today, over a century has passed. This still remains the standard tool for measuring inequality. We need not worry about the mathematics behind it. It is extremely simple to understand the Gini coefficient. A Gini coefficient of 1 means that all income earned in a country is earned by one person only, the rest of the population earning nothing. A Gini coefficient of 0 means that all income is equally distributed right down to the last rupee. Nobody is earning anything more or less than the other person. If there are 1 crore citizens of a country, the total income is distributed by 1 crore. That's it. So obviously, whether it's the first situation or the second situation, they are highly unrealistic. What it means is, if the Gini coefficient is more than 0.5, that is 0.6, 0.7, lot of inequality. If it is less, 0.3, 0.35, 0.2, 0.25, relative equality. So we have to understand inequality in the context of where it exists and how it can be measured. India had a Gini coefficient of 33.6 in 2012. Not bad. There are a lot of people who are very wealthy. There's a huge population below the poverty line, but the relative inequality was not too bad. But once again, this figure is disputed. There are people who say, you can't club the USA and Sweden and the UK and India in one. You have to take India in a different bunch. If there are some 196 countries in the world, you have to place India in a different group of maybe 30, 35, 40 countries of which are at a similar stage of development. And when you measure it there, our Gini coefficient is almost 0.5 in that group. Whatever it is, we are not super unequal. Whether you're not very unequal or not, it is good to move towards a little bit more of equality. If we take the world figures, very interesting. As you can see here, the green and the lighter green, not 1 and 0, this is made 100 and 0, so 30, 40, but it's easy to understand. You see, India here is somewhere in the 30 to 35 or the 0.3, 0.35 range. Australia, you'll see a lighter green, that is more equality there. Some of these things are really, really interesting. The United States, with its large number of billionaires and super billionaires, is more unequal than, for example, India. Canada is much more equal than the United States. And when you look at the whole of Central America and Latin America, only now there are more and more democracies. But formerly there were a large number of dictatorships, large number of including military dictatorships. So you find quite serious inequality there. Similarly, when you go to Africa, especially South Africa, still recovering, Zimbabwe recovering from apartheid, etc., where assets and income are relatively unequal. You see a lot of dark here, but as you come towards the northern part of Africa, countries that have sort of shed off the dictatorships and switched to democracy, you see different things. China, where you have got a communist party, is the owner of virtually everything and everybody. It's not a good color. But if you see Europe, lot of relative equality. Soviet Union also not as bad as China. This is Russia now, the old Soviet Union. There is relative inequality. So this kind of thing, it gives you a fair idea that there are pockets of the world that have addressed the whole concept of inequality and other pockets that have not done it. How do you tackle inequality? There are two approaches. You can go by the extremist approach and the incremental approach. Mercifully, the incremental approach has been chosen because the extremist approach has almost always failed, either sooner or later. One classic recent case, I'll just give you one example, is what happened in France. In France, when the previous president, Sarkozy, was defeated in an election in 2012, the new president was François Hollande. During the campaign, François Hollande had said that he is coming out with a 75% highest bracket of income tax on those people earning more than 1 million euros per year. When you look at it, 1 million euros, by their standards also is very wealthy. 75%. But what happened? He was able to collect only a pittance. Why? Most of the people who are in that bracket left France. One took Russia, an actor took, I forgot his name, but took Russian citizenship. Somebody else took Belgian citizenship. People started shifting off. When somebody is earning more than 1 million euros and is going to be taxed at 75%, that person can afford to hire the best advisors in the world who will tell him what to do not to be taxed at 75%. And this was done. What was the fallout? The fallout was bad because suddenly France was viewed as a nation that is business unfriendly. Investment was hit. Lot of bad things happened. The economy contracted further. The popularity of the president plummeted to an all-time record low after World War II. François Hollande became one of the most unpopular presidents of France. And ultimately, he had to get rid of his, the equivalent of the finance minister, have a new business-friendly finance minister called Manuel Valls. After 2 years of the 75% taxation, it was done away with, given a quiet burial. And now they are toying with more business-friendly and other ideas. So that was the extremist approach. The incrementalist approach is what we have seen in this budget. You are earning more than 1 crore, you had 12% surcharge. 12% surcharge will make it 15% surcharge. The additional tax on dividend. Okay, some small tweaking here, there, getting rid of some concessions, some other things, but affecting all the people who are earning substantially higher. This, of course, has a much better rate of success, and that's why it has been adopted. Moving ahead, I was just trying to talk to you because sometimes when the government comes out with policy, just reading the policy and seeing how it affects us is one thing. But I think a much deeper, much richer experience is trying to go behind the government's thinking. Place that thinking in the context of what's happening in the world, what are the ideas being circulated, and trying to understand. That gives you a much richer experience of the whole thing.